Good morning, everybody. We are very warmed up after a very interesting opening panel. Star-studded, outstanding indeed, as we've heard. And I think our juices are flowing very nicely. You have an equally interesting star-studded panel before you. We will be discussing the topic of the outlook. We have an interesting mix of characters on the panel. We have real industry corporates who are diversified, who actually do the actual investments in the different sub-markets of the continent. But then you have, of course, a very important stakeholder in the name of Moody's, who do all the difficult risk assessments and the ratings for banks and other corporates, different situations. And we have an investment fund, a very successful one that has done phenomenal work over the years in the continent, Helios Investment Fund. So we will try to unpack the very interesting topic of the economic outlook. We sometimes get very seduced by the macro picture, and we tend to focus on headline numbers. And President Adesina just told us we can't eat GDP, and I think others would tell you GDP has limited application because it's just such a highly condensed statistic. So we're going to be hearing from these very interesting, informed leaders in the various segments of industry to tell us what their take is on the African economic outlook. There's tailwinds, there's headwinds, there's all sorts of moving factors. How do we begin to digest this? How do we synthesize this? So we have Marie Diron from Moody's as a managing director. We'll kick off with her.
Thank you. Thank you very much indeed for inviting us to share our outlook. And indeed, as you said, GDP is very much a starting point, and Africa and the various countries in Africa do enjoy relatively robust growth. The way we look at this, though, is growth then generating increasing living standards? From a sovereign perspective, that is essential because that is really what enables the population to then face future shocks and be resilient. I think, as we all know, the last few years have been very turbulent around the world. African countries have certainly been affected by that turbulence, and that resilience, that really capacity of a population to absorb the shocks is essential. The growth is also essential to generate government revenue, and then that allows recycling of this revenue, repurposing of these revenues into essential spending. And what we've seen in Africa is really varied experiences, and you will see that reflected in our sovereign rating actions over the last few years. In general, the continent, like the rest of the world, is coming out of these years of turbulence with more government debt. And so on average across the continent, it's a debt burden, a debt to GDP ratio that is at 63%. To put things in perspective, it is 10 percentage points more than in 2019, before the pandemic, and it's twice as much as 10 years ago. So a debt burden that is indeed significant. Importantly, that debt burden becomes even more real and more concrete when you take to the implications in terms of debt service. A metric that we look at is really the proportion of revenue absorbed by interest payments. I think those of you managing budgets, whether it's a corporate budget, a government budget, a multilateral development bank budget, would relate to that. Interest payments is essential, but there's also a lot of demands on that budget that are equally essential. And when we see that proportion dedicated to interest rising, then that poses difficult choices for sovereigns. Now, President Dr. Adesina made a very good point. We can't just talk about Africa as a bloc, and indeed our analysis is very much done at the country level and then at the corporate or financial institution level. So let me give you a few examples of some really kind of hopeful and really positive measures that we've seen taken in the continent. And we, again, reflected that in rating upgrades, positive outlooks on some of our sovereign ratings. One of my colleagues, John Walsh, I see here in the room, recently published a report looking at 5 examples, 5 countries in sub-Saharan Africa, Angola, Cote d'Ivoire, Eswatini, Nigeria, and Tanzania. And there we've seen a range of measures that are really looking at strengthening the revenue base, are looking at reducing wasteful spending, in general, are looking at really strengthening the country's institutions through fiscal, monetary, institutional reforms that we think will give more resilience to the government. So there are many ways to do this, and each of these countries is really looking at prioritizing the most effective ways. In some cases, there's really quite a wide range of reform. In the case of Angola, Cote d'Ivoire, and Tanzania. Other cases more focused, Eswatini on the fiscal side, Nigeria on the monetary side. The point here is that there is scope for governments to really identify key steps that will enable them to rebound from the shocks, to prepare for future shocks, and then seize that immense potential that we've heard about so eloquently in the previous discussion.
Well, Marie, that's been a very interesting opening remark that you've made, because we're not accustomed to hearing the sounds of upgrades. We're more used to hearing the sounds of downgrades. So I think this is building on the positivity from that opening panel. And you've given us live, real cases where it shows that Moody's is actually fair. You do look at all sides of the equation. And I think the debt issues that you've highlighted have been very, very high on the agenda in terms of ensuring that we're sustainable. And again, the 63% number gives us hope that there's still some headroom for us to deal with future shocks. So this is very much a macro kickstart to the discussion, but we have a real economy player in the name of Arise, doing very interesting things across a number of sectors, and you've also been a pioneer, actually, helping to move upstream and get projects up and going in an environment where everybody complains that there's no bankable projects. So Gagan, could you give us perspective? How do you see the outlook? Do you still have appetite? Are you retreating? Are you going deeper?
So I think I'll a little bit start with rewind. If you look for last 10 years, Africa has been actually a success story. If you look for last 10 years, you had, despite various crises, be it the commodity crisis we had, 2012, 14, 30, petrol went from $100 to $30. You had the COVID, then you had Ukraine. And Africa did not have the printing machine, which US and Europe had to print whatever money they print. Still, Africa grew by about 2.8%, Europe only 1.4%. That shows the resilience. I think if you look forward, and as he was saying, there are pockets of countries that are doing excellently well. And so if you look at, say, a country like Gabon, where we do timber transformation, the countries that have taken the journey to transform their raw material and export finished goods and not export jobs have done wonderfully well. So if you look at Gabon, their GDP contribution to the wood sector has increased by 4 times in the last 10 years. Other countries like Benin, it's very funny. So they export cashew at $750 a ton. This cashew goes to Vietnam. It comes back labeled by a French manufacturer, made in France, sold in Benin at $58,000 a ton. So you can imagine why the GDP does not stay. Also, I think a lot of banks are party to it. One of the biggest way the GDP is not captured in Africa is because of illicit raw material exports, where the money is actually sitting in trading hubs of Dubai, Singapore, or Europe. So good example, we looked at a country. That country used to export soya bean. If you look at their custom data, it's 40,000 tons of soya exported. They said we'll transform, and next year that became 280,000 tons of soya. So it means that 210,000 tons was getting exported but not captured in GDP. So I think Moody's and other agencies have to have a very different regard when they look at real GDP and not just go by the official numbers. They have to really feel the economy and not just the numbers that come out. I think we're very clear that Africa is the next manufacturing hub, and I see it's the next $1.5 trillion opportunity. And it's not that it's going to happen in future, it's happening now. So a good example, the world's biggest silicon metal smelter outside of China is coming up in our industrial zone in the Republic of Congo. And that should be operational in Q1 of 2026. One of the biggest polyester plant outside of Indonesia and China, 4,000 tons capacity is coming up in Republic of Congo, operational in Q2 of 2026. So it is here and happening. I think those who do not participate will miss the journey. Because my belief is, if you look at African resources, just metal transformation will add about $600 billion in terms of GDP. Agri, another $400 billion. And import replacement, another $200 to $300 billion. So you have $1.5 billion opportunity. We are very committed to it. We are in 12 countries, and we see it's only expanding from here.
Very interesting. Gagan, I think you have spoken to a theme that came out very strongly in the opening session. Samaila talked about value addition, right? The whole question of whether we're going to stay specialized in raw materials. You're talking about this in the agricultural context. Cashews, I think cocoa, coffee. We've been hearing this for a very long time. And we also heard about agro-industrial processing parks that are coming out that's going to put an impetus on transforming. You've been involved in that. Are we getting traction? Do you think that is a prelude to what we might see in the mining sector on the critical minerals? Or is Samaila being too optimistic?
I think both of them are happening. So for example, Benin has gone from exporting raw cotton. So a T-shirt, you export for about $4 to $5, unbranded. And the same cotton, when you export unprocessed, you send for 30 cents. So Benin in last 18 months have gone from exporting raw cotton to exporting 125 million pieces of garments. Fully integrated, fully traceable, 60% less climate when compared to its manufactured in China and Turkey. So it's happening here and now. I think what Samaila is saying is not future, it's happening. Similarly, on the metal transformation, it's happening. It's not that it'll happen in future. So I was talking about the silica smelter. So silica is a base material that you use for making semiconductors, you use for making solar panels, right from quartz to silicon smelter. So that'll be operational in Q1 of 2026. So I think it's just that it's beginning to happen. And I think a little bit of this whole energy discussion, it's a chicken and egg story. If people do not have money to pay for energy, there'll be no electrification. So what you need to do is create jobs. And this is going to also get aided by global demographics. So China is going to lose 216 million people in working class. And alone, Nigeria is going to add 114 million people. So automatically, that job shift have happened. And that has happened from last long history. So if you look at UK used to be a big textile producer, about having 51 million spindles way back. And all of that moved to China. And then China will shed that will come to Africa. So I think what Samaila said is happening is just that it's now beginning to pick up the pace. And I'm very proud to say that all this development is supported by African financial institutions. So AFC, Afrexim Bank, these are the ones who are propelling it. It's not money that is coming from outside. Because I think one thing that Africa also needs to think, and I say very jokingly, imagine you have a maid at your home, and the maid comes and says, I want to build a house. You'll ensure you give enough money to build a house on outskirts of the city. And I think same Africa has to have. They can't go to Europe and US ask for building a house. Europe and US will not give you money to build a business as competitive and which can compete with them. They'll give you only money to keep you quiet. So the people sitting here, Africa has to put its own capital. It cannot depend on somebody else funding money. That will not make it work. Today we are successful because we have Afrexim, we have AFC, which is African capital, which understands Africa and is willing to support it.
Well, Gagan, clearly you're building up from where Marie left off. I think the general outlook from Marie was risk is neutral to green, right? As green shoots, the recovery is happening, a few upgrades, and the worst might be behind us. Now you're coming on a little bit stronger. You're saying risk is on, right? So let's see how far that trend goes. We're going to come to Rishi now. Rishi, how on is the risk from your Legata perspective?
I think that there's always a measured balanced risk that you have to take in Africa, and I think everybody's always cognizant of that. I think what's interesting today, what you're seeing in groups like Gagan's particularly, is kind of homegrown champions. I think 15, 20 years ago, the likes of the multilateral financing institutions like the AFC, et cetera, were very actively going out to the West, not just looking for funding, but looking to try and attract investors from there to come in and to try and develop and to teach and to educate Africa on how to develop businesses. I think what's been a really interesting transition that we've seen, particularly over the last 5, 10 years, but I think you'll see very much over the course of the next decade or two, is homegrown champions that are coming up that understand risk, appetite much better, have learned how to operate businesses on the ground with all the deficiencies and all the constraints and all the problems that come, but they've grown up with those. They understand the power challenges because they've lived with them, the infrastructure challenges, so they don't come to conferences such as these and complain about them and talk about how insurmountable they are. They've grown up, they're used to them, they know how to adjust around them, and they get through that. And I think you see that very much with what Gagan's done, and you see how that means that groups like the AFC can now come and support you and make you their platform rather than looking outside. So whilst I think risk remains, I think the appetite of investors and operators on the continent to know how to adjust that, how to work with that, has improved significantly. And I think that's a great benefit and opportunity for Africa moving forward.
Indeed, Rishi. In fact, that opening session confirmed how far the continent has moved in terms of having very strong institutions that have that very close and deep perspective on the ground to enable that risk-taking and to handhold also investors and give them the comfort. I'm going to move quickly to another real economy player that is actually legendary in the African context. Those who know the term Helios, they associate that with pioneering success. Babatunde, are you still as active as you've been? I mean, we heard of some very interesting deal you did about 6 to 12 months ago. It caught a lot of us by surprise. Clearly, you have risk appetite, but how do you see the outlook? Are you going to go deeper and stronger?
Well, first, good afternoon, everyone. Hope the day is off to a good start. Thanks, Rishi, for having me here. Yeah. I think all we do is Africa. Let's start from actually, all we do is Africa. And I think what we see, I'll just get to the end and I tell you the why, is what you hear in here. It's just extremely positive. It's like the continent had, if you go back sort of 20 years, you had a period from 2000 to 2010 where the economies were growing about 5-6%. In that period, probably population growth was about 3%, so you had an additional 3% of growth from productivity, which I think came from a combination of technologies like mobile arriving, driving massive gains in productivity, all the elections and moving away privatizations of banks and everything else. They had a period which Gagan mentioned from 2010 to now, where growth slowed down. It's just a tick above population growth. So productivity growth has not been as strong. But as Gagan has said, there have been many shocks in this period, many shocks. And if you compare Africa's growth in that period related to others, corrected for the inability to print money, I think Africa is actually outperformed overall. But the phase we're seeing right now, I think, is people have just, at this point, I think, institutions have been built, like AFC, Afrexim, AFDB, and the likes, that actually understand the continent. I think the key to all of this stuff, so the progress, you need to have capital, some basic infrastructure. You need to have capital that understands the risk and can assess the risk-return ratios of things. You need to have people that have the expertise, that know how to build and navigate and have the right strategies. And it just feels across the entire continent, it's just coming together right now. Now, Gagan couldn't have done what he was doing 15, 20 years ago. I mean, Rishi, look at the things you're doing, I think you can do them 15, 20 years ago. And what we see across the whole continent, from north to south to east to west, is actually we're just seeing a lot of innovation, a lot of opportunity, a lot of entrepreneurship, a lot of creativity just across the continent. And also, actually, I would say probably one could argue better leadership. You have governments passing policies that reducing wastes, improving tax collections, have direction, focused on infrastructure, more market-based policies, and all of these things coming together at the same time. So I think it's just extremely, extremely positive next few years ahead for the continent. That's what we see.
This confirms a thesis that those who are actually on the ground doing business feel that the risk-return relationship is actually very much in favor of the return side, right? Because I think the opening panel and many debates we hear is that the risk perspective on the continent is usually a little bit to the negative. There's a little bit of a structural bias. I think this is what we often hear. When you look at the net resource flows over the past couple of years, they've come down dramatically. It was about 217 billion just before the pandemic, and it dropped 20%. The only resource flow that has upheld itself is remittances. Every other flow has gone down. ODA, FDI, portfolio investments, everything is down. Now that the risk perspective seems to be easing up, and of course ratings agencies have a gatekeeping role in many respects, do you think this bottom-up, more positive risk perspective will begin to filter into the macro perspective? Marie?
Yeah, no, very, very good point. I think our analysis of really where credits are and where financial market risk appetite is very much at a point of differentiation. I think it's undeniable that there is competition for capital. The world is, there is liquidity out there, there is capital, but it is relatively scarce compared to the 2010s. We had an event a few days ago for emerging markets in general, and that was very much the theme, that competition for capital, hence differentiation, hence really that kind of potentially divergent stories, divergent outcomes coming between those credits, sovereigns or corporates, that will have that really sound fundamentals, sound governance, and credible story going forward, and those who do not. And I think we do see that in Africa, and we do see that in our sovereign ratings. So since the beginning of the year, we have seen some sovereigns, Côte d'Ivoire and Benin, for instance, issuing on international bond markets. And it is really because with that kind of credible story, really predictable policy making, then they are able to attract capital. For others, it does remain really relatively challenging, and we see the cost of capital still being very high.
Cost of capital, it's the big theme. Babatunde, how does the cost of capital feel? Are you managing to jump up to the higher hurdle rates, or are you struggling? Do you find that it's pouring too much cold water on your investments?
Yeah. What I will say, I think, is there's cost of capital in sort of two currencies. There's the local currency cost of capital, and there's the US dollar cost of capital. And also Africa is not one country, because we have countries on the continent that today, in places like Morocco, you can borrow money at 5-6%. It's actually pretty amazing, yeah? In euros, in essence, basically. And you got places like, Nigeria, where in local currency, the cost of capital is, but I think one cannot look at things just at a point in time. You got to sort of, I think, understand, look at over a long period of time, understand there will be periods where things will spike. 2 years ago, you could borrow money in Nigeria at 12%, 13%. Now you got to pay 30%. So I think right now, in some countries, it's actually extremely hard to figure out what the right, how to price what you're invested in. And in some countries, it's actually relatively clear and simple, and it goes on roundabout, So I think, but in the long run, I think, the big economies of Nigeria, Egypt, South Africa, and the likes, Egypt and Nigeria, especially right now, going through periods where the cost of capital is actually extremely high because of high inflation and big devaluation. But I think one just got to see through the current last 2-3 years and think a bit further out. I know there are periods you take the pain, but the benefits will come at some point in time.
Rishi, with a strong leg in a city like London, are you able to buck this difficult trend of much higher cost of capital? Does it make sense for African firms maybe to try to co-locate in the UK and try to deal with some of these difficult cost issues on the capital side?
Look, I feel in a sense the cost of capital is the cost of capital. You can adjust it and you can play with it and you can try and be smart to some extent. But to try and hope that you can make a project commercially viable through a co-locating headquarters or something is a bit idealistic, and I have seen a lot of people try to do that. I feel you've got to look internally, you've got to look at your own operations. Critically, you've got to look at your governance. You've got to make sure that you're getting your governance right, that your business is run in the right way, which increasingly it is. I remember talking with Baba and looking at some of the companies they were looking to invest in 10 years ago and seeing how much they struggle to educate them in a lot of cases to try and get them to understand how governance works and how you follow ESG standards. You don't need to tell companies this anymore. And as soon as you do that, you can access, you can find interesting ways to access money at sensible rates, depending on your project, once you've fixed yourself internally. And I think you see that. Look, I mean, if you look, as we've all talked about, the last few years have been an incredibly challenging time for Africa. We have to be honest. Sure. After COVID, but critically the interest rate situation, et cetera, what it's done to the cost of debt all over Africa. But still today, you see 12 of the, I think it was the EIU report I saw recently, 12 of the 20 fastest growing countries in the world this year will be in Africa. Even with all that going on, it just shows the resilience that is kind of embedded now in so many of these. And this is often the mid-sized countries rather than kind of the largest ones that you're seeing there, which is even more impressive to me because you're seeing in countries like that where debt and capital can move so fast out of the country that they're still able to perform, sometimes because of a few individual natural resources projects, et cetera. But the very fact that these smaller countries are able to execute them and develop is very impressive, I feel. And you're seeing that, I mean, for example, everybody in Nigeria talks about the refinery that's come up. But at the same time, simultaneously, if you look at Nigeria's becoming one of the world leaders in urea production, again, through Dangote and other producers. And that's something that people have been talking about for decades, but you really see it in front of you. And even there, with a higher cost of capital than they would have liked, they're making that work very well. So I think there are such opportunities and ways to get these things done.
Yeah. I mean, there is clarity that Africa is a growth continent. I think even if you look at the past 20 years, there was 1 year where we went into recession. But since the turn of the millennium, we've been growing, which is very different from the 90s and 80s. So we are growing. But the real question is the holy grail of transformation. Structural transformation is the big ticket. It's the big prize everybody's chasing. Whether you look at mining and critical minerals, or you look at agriculture, it's the same problem, right? The whole thing is how do you get that value addition? Agriculture has had a little bit more of a head start in terms of industrial processing zones, agro-industry and the like. And I think that's going to be a test case, and that might pave the way for minings and critical minerals. Do you think that the Holy Grail is a bit more within reach in terms of your outlook today?
So I think I'll put a very different perspective to risk and the investment. When people go and invest in Libya in drilling petrol, is there no risk? When people go and invest in countries where the resources are, to take out raw resources, people don't feel risk. Because the system is designed that way that you are able to appropriate value at a very low cost and move it somewhere else. And people don't see risk. You have large corporates that go and invest in geographies to take out raw material and they don't see a risk. But when it comes to transformation, you see a risk. Because you have to realize the global system has been designed that way to ensure that you transform in Africa. And that if Indonesia is why it's successful in nickel transformation. Indonesia said, I will stop exporting nickel, resources with me, please come and transform where I am. And automatically, in less than 4 years, $18 billion went into nickel transformation in Indonesia. I think African policymakers need to be aware they sit on resource. They don't need to be driven by saying, okay, no capital is coming. When you say, I will not export raw, automatically value will come in your country. And we have seen that happen. So in 2010, Gabon said, we'll stop exporting round logs. Everybody was against it because companies in Europe are going to lose jobs. People said, no, it will not work. Thanks today, you have 18,000 people that come to work in the zone. The GDP contribution for timber sector has gone up by 4 times. Tax revenues have gone by 18 times. Because that country has taken a decision not to allow the export of raw material. So for me, this concept of risk is completely created to ensure investment does not come. When you are happy to invest for extraction of raw material, there's no risk. For putting a plant, there's risk. So no, it's not like that. So I think you will see more and more investment comes as the countries get bolder. They say, we will not allow raw material export to happen. I think second thing, global macroeconomically, things are changing. I think what is happening between Europe, US, and China, where people want to shift manufacturing away from one destination, that will aid a lot of transformation into Africa. I think what is happening, I think, as Samail and Adesina talked about, it's a growing market. If you go to Nigeria and go to West Africa, I mean, just Nigeria imports $1.8 billion of textile, and that's official import number. $1.8 billion of imports number. I went to supermarket. I looked for, not supermarket, the street market. The second-hand undergarments that are sold there are more expensive than new undergarments in India.
So
That
clearly,
shows
you
massive
believe
transformation possible.
you're a strong believer that the Holy Grail is not a pipe dream in this case.
It's
Transformation,
happening. It's just
value addition, it's a real prospect. Babatunde, would you invest in that kind of a value
He
proposition?
knows the answer.
yeah.
You would.
And so, of course it is, yes. Of course it is, yes. Well, because the thing you got to make sure is that you're doing it where you can be cost competitive against imports. So when the governments change their mind and say, we reduce the taxes, you still are profitable. And there are many places in the continent where you can be competitive globally. A good example, actually, we had a business Nigeria is the biggest importer of tomato paste in the world. Nigeria produces enough tomato, but about 70% of the tomatoes that are farmed get spoiled, destroyed, squashed. We bought a business, big business, Nigerian government banned, actually. The government banned production of tomato paste. On the back of it, we created a business, and right now, it's incredible. When we started, the yields were in India and China, they're getting like 60 tons of tomato, 40 tons of tomato per hectare. We were doing Nigeria 5 or 4. Today now, the farm is doing about 30 tons of tomato per hectare. So I think it is possible. So right now, if you add what they're producing, it's cheaper than if you add the import costs and import duty and FX issue, it's cheaper to do it than actually importing it.
I think
you've got to pick your sectors.
I'll just add to what Baba said is very important. It's not that every country in Africa should manufacture everything.
Correct.
You'll have cost competitive sectors depending on what raw material they have. So if a country has tomato potential, they'll produce tomato to serve to others. If a country has cotton, they'll produce textile. If a country has timber, they'll produce timber. And I think that is where AFCTA comes in place. And we are seeing the early benefits of it. For example, a particle board or a plywood made in our industrial zone in Gabon is going to Niger, is going to Togo. We see the meat coming from Chad is going to Angola, is going to Republic of Congo, is going to Gabon. So I think you'll start seeing these countries with very specific raw material, which they can transform competitively, start to trade within Africa. And for some countries, competitiveness will come from labor advantage, some power advantage, just having flared gas. So every country will have its own specific advantage. It's not that every country will be able to do everything.
But in
Rishi, do you think that we're on track?
Yes, I think just in addition to that, but definitely showing that we are on track, is that what we're seeing is that governments are getting smarter and more sophisticated as well. In some cases, you can, as you say, just slap a ban, and they have to be tough. And an example like Indonesia, where they know the power of their nickel. But for example, somewhere where Gagan and I have been talking and working closely is in cashew in Côte d'Ivoire. Now that's a phenomenally more competitive sector. Ivory Coast being the largest player in Africa, but not the largest player in the world. They can't dictate terms dictatorially to the world on this. But 10 years ago, there was no processing in Côte d'Ivoire. By next year, they'll be probably pretty much the largest processor on earth of cashew, because they've put in a system of subsidies, grants, taxes, support in a very sophisticated way that you would not have expected 10 years ago a country in Africa do. Employed tens of thousands of people, and that's all through that's all through foresight and a lot of deep thought that's gone in. And that's what you're seeing happening in different sectors throughout the continent now.
We have 1 minute left before we close the panel. I know it's not enough to have much of an interaction with the audience, but does anybody have a burning question or a provocative question before we close the curtain on this discussion? I have the gentleman from Citi, Miguel. You have the one question.
I remember being here 10 years ago, and the narrative was Africa rising. Everything was very bright or looking bright. 10 years have passed. I think the perennial debate, macro discount and micro premium, macro being governments, micro being companies, is less favorable. The micro premium is there, but the macro discount is much bigger. The risk premiums are up. So I would like to ask the panelists, how do they feel 10 years on? How do they feel frustrated for the last decade? Do they feel hopeful for the next decade? Do they feel a combination of both? Where exactly are we?
Your question is a perfect transition towards closing the panel. I'm going to start with Babatunde. Okay. And maybe to make it efficient without you having to explain too much, on a scale of 1 to 10, 10 being the Africa rising narrative is super hot and 1 being super cold, where would you say we are as a synthesis vote from your end? 1 out of 10.
I would say actually we're more towards the 7.5, 8. And the reason I'll say that I think is, I think Sabala mentioned this earlier actually, it's the trajectory we're on rather than a snapshot of where we are. And I think the moving of the pension, we've got about $2 trillion of pension money across the continent. The capital is there, and the debates and discussions of how to, I think there's no continent that's been developed by foreign capital. I think it's about using the capital we've got domestically to get it to develop and manufacturers produce stuff for us. And that debate with people like the institutions of Afrexim, AFDB, but also there's more of it happening. And I think when that actually does happen, we're going to see the results. And it's going to be absolutely transformational.
Thank you. Rishi, your finger on the pulse, 1 to 10. What's your take on how hot is it?
One number for all of Africa and everything to do with it is difficult. But I would say when we talked about the Africa rising narrative, it was very theoretical. 10 years ago, I wasn't talking about it, but people were. But when you ask whether we're frustrated by the last 10 years, I don't think anybody here would say they're frustrated by the last 10 years. 10 years ago, my business was much smaller. Guggen's business was much smaller, right? We've had a very successful 10 years. There are people where that's happened, and these overarching narratives and themes that people have kind of generalized with have completely misunderstood and taken us in the wrong direction. In the next 10 years or 20 years, in the next 25 years, we're going to add 1 billion people on the African continent. It astounds me that people think that that is a challenge. Of course it's a challenge. There's lots of challenges. But Africa is going to be a different place in 20, 25 years. And there's going to be so many interesting things that arise from that. So much opportunity. And so, we as a group are positive. What we see from outside goes in cycles, ups and downs. And we have to just continue to be stable, positive, and keep moving in the right direction.
So it's complex and very difficult to sum up. Last word for you on the vote. Do you think?
Clearly, I think last 10 years are outstandingly well, I would say. And very hopeful for the next 10 years. If you were to put a number, it'll be between 7.5 and 8. And I think, as I said early on, I see clearly it's about $1.5 trillion manufacturing opportunity. And it's really for people who can come and participate. Otherwise, somebody else will come and participate. So very, very hopeful and very bullish about it.
So Marie, the guys on the ground are quite optimistic, right? That's the general consensus. Are they smoking something in your view?
So I'll use my own scale, not the 1 to 10 that you offered us. The rating scale that we use to make that differentiation, as you said. 1 number for the continent, I think, is really challenging. The Africa rising story is very much demographic dividend, natural endowment. Conditions are there for the continent to boom. And indeed, that's significant. And where we see that playing out is in countries like Morocco, Cote d'Ivoire. So on our rating scale, rated BA1, BA2, very much on par with global average, where that demographic dividend, natural endowment is combined with the strong governance, the investment in infrastructure to really be able to realize that. Other parts of the continent we rate much more lowly, not because the demographic dividend story is not there, it is there generally across the dividend, but because we're not seeing the complementary aspects that really allows these countries to seize it.
Thank you very much, Marie. I believe we've come to the end of the panel, ladies and gentlemen. The summary is risk is on, the outlook is positive, very uneven, of course, that's the hard reality. It's not the same everywhere, but clearly the long-term appetite and long-term view is quite robust. We keep our fingers crossed, and on that note, a round of applause to our panelists.
Admasu and panelists, thank you very much indeed for that excellent panel. We heard about the challenges of debt servicing, the proportion of reserves eaten by debt payments, and how that is increasing and creating some challenges in some African markets. But I thought the overall theme and feeling of the contributions from the panel was unreservedly positive. Despite the shocks, there is risk, but it can be managed. We're increasing value added taking place on the continent, innovation and opportunity taking place, embedded resilience, structural transformations, key themes coming out of the contributions from the panelists. And of course, the panelists, Marie, forgive me for accepting you from this, are actually running businesses in Africa, employing Africans, and actually generating returns and improving lives. So if anybody's going to know and have an accurate assessment of what is actually happening in the continent, it's the investors and people running businesses on the continent. So thank you all very much for your contributions on that panel.